What's going on? It's your friend Jack here, and today we're going to be reporting with the Blue Snowball mic, this big old chunky hunky thing, about how you could become a millionaire using your tax-free savings account by the time it takes you to become 20 years old, or rather 20 years or less, or something like that. Anyways, let's go take a look. So I know that intro was a little off the charts goofy, but this is not an April Fool's video. I did post this video on April 1st, that is today, but this is no April Fool's joke. We're going to be taking a look, written by the Motley Fool, the infamous Motley Fool, about how you can use your tax-free savings account to gross an amount of $1 million tax-free. And if you can live off $1 million that is tax-free, well, you're pretty well off for the rest of your life. So if you can do this in less than 20 years and you're my age, you're looking at some nice early retirement. So with all that being said, let's go take a look at this infamous article and let's go become millionaires with a tax-free savings account. So something to keep in mind while I pick up my microphone is that in 2019, however, the contribution limit for your tax-free savings account is still $6,000 a year here in 2021. But let's go take a look more at this article, and the first headline of the article is use your TFSA to become a millionaire, which is what this video is about. So let's get right into the bulky stuff. Basically, it starts off by telling us about a tax-free savings account, and although it's going to put down here, so they announced in 2020 they would remain at $6,000 for the contribution limit, and since it was introduced, the max a Canadian could put their account to or contribute into their tax-free savings account would be $69,500 if they were 18 by 2009, essentially, because you don't start getting contribution limit room until you're 18 or older. So let's take a look at this. How are you going to get from $69,000 to $1 million in a tax-free savings account when you can't really contribute anything more than that? And they mention here, on the surface, reaching $1 million in your TFSA balance appears daunting. And that's because it is. It's 14 times the accumulated contribution limit, which is quite hefty, I might say. That is hefty. That is. And this has led some investors to believe that it can only be achieved through aggressive stock trading and investing in speculative high growth stocks. And the reason they say this is because if you can up the amount in your portfolio, in your tax-free savings account, like let's say you put in $69,500 in the stocks into a single, GameStop stock, and at 300%, then that limit or that room you just hit and you sell, and you have $500,000 in your account right now your contribution limit is $500,000, which is insane. And that's why most people go to tax-free savings accounts. And they think, oh, let's just start trading and growing this account as risky as possible. But the thing is, there's a counter side to that. If you lose your money, your contribution limit can actually go down. So it's double-edged sword. You got to be careful. And definitely make sure you know that when you're trying to, get fancy with your trades and make some big profits on volatile stocks. Be careful. You don't want to lose contribution room. It is not something that is a, good thing. But let's go forward here and let's look at the rest of what they have to say. So aside from the considerable risks involved, it is highly likely that many investors would lose their capital. Most people don't know what they're doing. They're taking speculative investments. They're not even investments, really. They're just speculating. They're not really researching. They're not going into these companies because they like the company. They're going into them because they want money. And that's not really the way to make long-term investments. And most people try to do short-term investments. And another thing to keep in mind is that if you're day trading on a TFSA account, you're going to get in trouble. There's a good chance if you're trading and selling, buying and selling every day on your tax-free savings account, the government's going to come for you. So you can't do that. You're going to end up actually having to pay taxes on that, and sometimes more than you would like. So be careful with too much trading activity. It could be determine that you are a business, and they're not going to like that. They're not going to make it a tax-free savings account if you're using it like a business. Keep that stuff in your personal portfolio. However, let's look at what else they have to say. So they also look over here, what I just mentioned, the CRA is targeting accounts where there is frequent trading activity and large balances because it could be considered that they're a business and using the tax-free savings account to avoid taxes. Let's keep scrolling. So it is therefore preferable to take a disciplined long-term approach, acquiring high-quality, lower-risk, dividend-paying growth stocks. Dividend-paying stocks are a huge asset in today's economy. I think dividends are awesome, and also there's companies that have DRIPs, which are dividend reinvestment plans, as I mentioned right here. These have these companies usually are companies that have been around for a long time, and they actually pay, or they don't pay you directly the dividend. They reinvest it automatically into their company. So it's kind of a weird way of saying they give you more stock when their stock, instead of giving you a bunch of dividends, they give you some more stock, which is really cool. They put their money back into themselves using your money, and it grows grows the amount of assets you have, and it grows the company. So it's good for everyone. And catch here, it increases your contribution limit, and you don't, it doesn't actually take from your contribution limit or your contributions. It just increases the limit. It's a gain on your account. So it's a good thing, especially for long-term investors. If you can, hold these DRIP companies that are reinvesting in themselves and giving you more stock value, upping your contribution limit and the amount in your account, you can use these to essentially use compound interest over time. Once that number gets up there higher and higher, it's going to start going crazier and crazier and getting more money per year, per month, per whatever term you want to look at. Take, for example, the compound interest or the compounding effect of a penny. If you start with a penny and you double it every single day, you're going to end up with many millions and millions of dollars at the end of the 30 days from a penny. So keep that in mind when you're looking at stocks. The more you go up, the more you can go up. So something really valuable about dividend stocks is they increase your contribution limit without actually using your contribution room, which is really valid. And you don't have to take huge risky positions that can be qualified as a business if you go the growth stock volatile route. Now, how could you get from $69,000 to $1 million? Well, right here they do mention 5 stocks that you could take in your portfolio to kind of do this effect, but make sure you're doing your own research on these stocks. You don't want to just go into random stocks at random times with no really knowledge about the companies. Do your own research and make your own choices. That's honestly the best advice I can give anyone, and learn from your own experience as well. Definitely don't want to just YOLO your money into something that you have no idea about. Get a little bit of an idea of what you're doing before you actually make big moves. And also something to keep in mind is that you can do dollar cost averaging, which is basically taking the emotion out of trading. You just invest X amount of dollars every month, no matter where the markets are at, and that kind of averages your risk out a little bit. I have another video on that if you want to know all about it. There's lots of videos on the internet about dollar cost averaging. It's a very useful tool. But let's keep going. Let's keep scrolling. We don't got all day here, and this video is pretty much very long. And okay, so how are we going to do this? How are we going to get to $1 million? So, while performance is no guarantee on future returns, that's true, that portfolio of stocks has an average annual return of around 12% over the last 10 years, which is pretty darn good. That is very good, better than the S&P 500. Probably, maybe, don't quote me on that one, probably, maybe not, but over the last 10 years, if all dividends received were reinvested, if you had never made a TFSA contribution and invested the maximum amount of $69,500 at the start of 2020, added $6,000 annually, and reinvested all the dividends, you would have $1 million tax-free savings account balance in just under 20 years. Only $6,000 annually. That's only $500 a month. $500 a month. Reinvest your dividends this is after you reach the contribution limit. So reach your contribution limit, add your max every year, $500 a month. That's all it is right now, which isn't very much, honestly. It's not. I'm sure people could manage that. There is people out there who are spending $500 a month that they could be putting in their tax-free savings account, and you reinvest all your dividends. If these markets perform the same over the last 10 years as they had the previous 10 years, or if they continue to perform at the same rate of return, you'd have $1 million tax-free savings account in just under 20 years. So think about that. Think about that for a second. Under 20 years, which is insane. How can $69,000 go to $1 million? The answer is compound interest, and compound interest works with time. Work your money in with your time. It's actually pretty awesome how this is even considerably possible. Even if your rate of return was 2% less, the amount you could have in your tax-free savings account is immensely more than if you just have your money sitting aside in some 2% high yield savings account, which you can't even get in Canada. You can't even get a 2% high yield savings account. It's very rare. So there is some risk to this, obviously, but if you're a long-term investor, the risk is very minimal. Unless the market, blows up and just fades away, you're going to be better off doing this than putting your money in a savings account where it's losing money to inflation. Now, it goes on to talk about the companies that they talk about this, but a disciplined approach is always better, using quality dividend-paying stocks and accessing the power of compounding by reinvesting the dividends. Reinvesting the dividends allows you to increase your contribution room over time, especially because we are reinvesting all our dividends. Our contribution room is going to get bigger and bigger and bigger. And if we want to take all that money out, our contribution room is still there as long as we, exited at a profit, meaning we had more money than we actually put in. Our contribution room is still going to be there. So very, very effective. And it does, it reduces risk by doing it over long-term growth or long-term investments, repaying those dividends back into themselves. Also, that's like not money you're going to be terribly annoyed if you lose some of it, right? Because it's not actually coming into your balance, it's automatically reinvested. So you're building yourself a nice set of money, a set of cash for when you're 40. For me, it's when I'm 40. I'm only 21 right now. By the time I'm 40, if I have $1 million in my tax-free savings account, by this simple approach of just putting $6,000 a year in, I'm going to be pretty happy with that. So that's the video right here. That's all I got for you guys today. Hope you guys enjoyed it. The Motley Fool is pretty cool, and I'll link this article down in the description. Obviously, this number is based off a 12% annual return, so it's a bit swayed. The 20-year mark might not be quite as feasible as over the last 10 years, but still, nonetheless, the power of compound interest is out there. So if you're investing your money rather than spending it on silly things, you're going to be better off in 20 years than someone who didn't. Anyways, thank you guys so much for watching. As always, keep learning, keep earning. It's been your friend Jack. Peace out.